Sure, it would be an independent team, right, based in Mumbai as opposed to Delhi. So I think that's one, because what we want to be able to leverage from a CX perspective is actually, we still want to access very strong promoters and very strong businesses. To us, it's no different fundamentally in terms of those core characteristics of the types of businesses that we want. What we may ask them to do is going to be fundamentally different, or what they may want from a capital source will be fundamentally different. But the key is, we want to, as an investor, I want to access growth in India. Okay, so if I can access growth in multiple ways and have a very interesting risk return in different ways, that's very interesting to me. Do I believe that CX as a firm and a mindset can help introduce this independent team to wonderful businesses run by great management teams that they've acquired on sectors that they have experience in? The answer is yes. And so it's also strategic, I think, because it allows CX then to offer another solution to a partner that they want, as opposed to losing business, so to speak, because they may not be the perfect partner for pure equity capital. And in many cases, some of the best management teams or the best owners of business don't want to part with their equity, right? Because they believe, and we want to do business in particular with people that don't want to part with their equity, because their businesses must be that good. And so if we can offer them a solution, then it makes sense for CX to offer that solution. It is, look, frankly, I think the media has gotten a little ahead of itself in that perspective, because we really have just started 2 weeks back. So it's early. I think people that know India absolutely get the strategy, right? They say that, it is a strategy that fits the structural constraints of India, the dynamic of the kind of the promoter mindset of India, in a way that I think really kind of resonates with people that know India. So ultimately, we're going to have to educate, because it's a new way of thinking about investing in India. It is very much the combination of accessing healthy businesses, right, who for one reason or another don't find themselves excited about taking private equity. It may be because there's a valuation gap. It may be because they don't want to dilute. It may be because there may not be this huge upside. They don't want to sell control, ultimately. So there are lots of reasons why very good companies don't want to take private equity. And so if you can go to that business and say, look, we're happy to take a little bit less return, but at the same time, we want to protect our risk in a much better framework. So if it's an offshore, Indian business, we want to have real collateral, offshore, et cetera, then that can be a very interesting risk return for us as a firm. And we want to be able to, the strategy wants to be able to operate very quickly with groups that they have an experience with and know, and very quietly. The level of involvement originated given that this was an area that I was very interested in exploring. So the credit opportunity for me has originated really back to 2005, when I invested in a Wilbur Ross fund in India that was thinking about the other side of the balance sheet. And I thought that was a unique idea at that point in time. And so for me, it stood out because it said, if you can buy businesses or get invested into good companies at a better price and then sell into this very high volume growth market, should make sense. My learning from that was that distress doesn't exist in the same way that we think about it from the Western perspective. And so it becomes very difficult to access distress in India. But the idea of accessing the other side of the balance sheet and providing people with capital that may or may look like credit in some capacity is an interesting concept. And so for the last 2 years, I've been thinking about it and trying to understand how others have approached this opportunity. And so from that perspective, I helped develop the business idea and the business case from the beginning. And like what we've done in the West, we decided to partner with someone as opposed to starting from a wholesale, especially a partner that we believe has great experience that I've talked about is very leverageable in this market. So we approached CX to think about this idea as a JV, so to speak, with really all operational responsibility following to CX as a firm and the new independent team. So on a personal basis, I am involved in kind of everything up to this point and getting the fund going. and helping them. My firm is introducing them to potential investors as well. And then on an ongoing basis, I will sit on the investment committee, on the offshore investment committee, to have a bit of a better look at companies firsthand. And so I think it will be a great way for me to even get closer to the market and really begin to sense where opportunities are and are not. We are looking for 300 to 350 as our starting point. I would say, in a word, LPs are skeptical. I think at this time, based on their experiences over the last 6 to 7 years. As you know, the Indian private equity institutional market really was created in 03, 04. And I think that many investors around the world looked at the top-down view of the demographic dividend within India, that regulation was pushing forward, that India was now an interesting place as a destination for capital. And based on that top-down view, because it didn't exist, people were willing to make that commitment. I think that fast forward 7 years to today, this leap of faith has turned into show us what's really happened. And if you look through, on average, it's not been a great result for investors to date. And so when you compare that with the experiences that they've had in the West and in China and other emerging markets, India hasn't necessarily held up. And I think the difference is ultimately it comes to expectations. What do you expect from a market? So in the West, I think you could say that the best player in India may have done at least as equally well as the best player in the U.S. And that may or may not be somewhat true, but it's on the order. But the reality is the expectation of that U.S. investor was they did better than what they expected. Whereas in India, that expectation was that's what they should have done. But it's the best, right? So I think that, from a Western perspective, that's how they think about it. And then they look at what's happened in China. And inevitably, China-India comparison happens all the time. And somewhat coincidentally, also China took off at the same time from an institutional private equity perspective. And the experiences in China have just been fundamentally different to date and over the last 7 years. And I think that was for a variety of reasons that were more fundamental to the opportunity set within China than they were in India, but it is what it is. And so now the question is, based on the past, how do we think about the future? And so I think people are holding on to their experiences as opposed to saying, which I get, doubt them for, but saying, okay, look, maybe India wasn't as ready as it should have been, or maybe we, in fact, as investors, pushed India further than it should have been pushed. But really, the fundamentals are in place. We have teams who have been experienced now, have done lots of deals. They have a better understanding of what can make money, what can make money. Hopefully now over the next 5 to 6, 7 years, the capital markets themselves will develop further, both on the credit side as well as the equity side, and that will give more support to the industries, and the outcome can be better. And I think people have to believe that, but they have to overcome their experiences to get there. And I think that's what's creating most of the skepticism. It is. I agree with you completely. I think it's this. The reason that you were interested in India from a top-down perspective in 04 hasn't changed. Maybe it's a little bit slower. You're a little more frustrated with the government change and regulation introductions, but generally you're saying it's a huge opportunity, a big population that is getting wealthier. You're seeing inflation growth, right? You're seeing wage inflation growth, and people are spending. So you say that's a great opportunity. Ultimately, though, GDP growth has to translate into returns for investors. And even more fundamentally, has to return into cash back in my pocket. And they haven't seen that yet. And it's been 7 years, 5 years, 7 years. And so it's been, there's been some patience that has gone to. It's not like we're expecting, cash back tomorrow. So the early investors have said, look, we've given some time, and we understand we've been through 2 bad cycles. So that's a unique environment. But again, you were growing through this environment, so where are we ultimately going to come out? So I don't think that it's a question of the macro opportunity. It's how do you turn that macro opportunity into real risk-return attractiveness for PE investors. It is, it's all of the above, right? I think ultimately there were lots of teams that created lots of liquidity. And when there's lots of liquidity in the market from a PE perspective, it can do nothing but, in general, harm return profiles. So I think that was one. I think two, valuations. In private equity as a whole, I've been fortunate to have learned, at least my early days of investing from some of the best PE investors I think in the world. And it's the fundamental rule is you make your money on the price you pay. That is fundamental to private equity. You can be in a growth market, and hopefully, ongoing growth of the business is there. But if you pay too high of a price up front, then it'll be very challenging to make a lot of money. So I think valuations have been very challenging. And I think Indian business people are very smart about when they raise money and when they don't raise money. And they figured out how to continue to grow even when capital isn't necessarily available to them, at least at the terms that they don't, that they want. So I think that's two. Execution in India is very hard, right? It's an interesting discussion. We had an internal IC about a company that we invested in directly in China. It's a low-end kind of budget motel chain. The business plan had this motel chain growing from 60 units to 450 units over a 2.5-year period. In any world market, that should be a challenging execution, strategy. However, you spend time with them, you see what the team has been able to do with other companies within China, and you say, look, that's more manageable. I see it. I can believe that that's achievable. And even if it's not 450, if they only get to 300, a 5x growth in units over a 2.5-3-year period is a tremendous amount of growth, and you just believe the scalability of that, and from an execution standpoint. In India, the same type of business, you hope to go from 60 to 120. And the reason is it's just been difficult, right, to source land, to source real estate, then negotiate that, then the build out, etc. So the scalability, execution of that, even though I think India has a fantastic management capability, is very hard. And so I think that also then has hindered, what you would hope to have seen from the size of business, from investment to where it is today. And then ultimately exits. Right, so how are you going to exit? If the IPO market isn't open the way it was in 05, 06, 07, how do you actually get out of the company? And you can say that you've created real value in a business, and that's fine, and we're patient investors. But ultimately, you do have to be able to monetize that. And so you have to think about strategic investors to come in or strategic buyers. Then you're saying, okay, should I have thought 5 years ago about this opportunity and that I would need to sell control of a business in order to interest a strategic? And this promoter is no way going to ever sell control of a business. So I think those have been, I think, the biggest hurdles. It's just not easy. I think it's very early. I think it's it's early to be hypercritical. It's early to say that it's the worst market in the world, which I've heard from a private equity perspective from some investors. So my expectation is that this will be a growing market. It should be, and it will be. Whether it grows as fast as it has, I don't think the answer is yes. I think people, will be a bit more cautious on a going forward basis. But absolutely, there's opportunity. There's fantastic growth, incredible management teams, and very smart people who want to build great businesses. So it absolutely should be in a destination, and it will be. It just will be, I think, slower now than it has been, with the possibility that if there's a global kind of resurgence, so to speak, that people with risk appetite on a global basis will come back in droves.